Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. And I want to remind you all to go to ETF.com and look up the Leaders tab for your chance to enter your company or yourself as a top financial advisor or top RIA firm. It's a simple form to fill out. You have until the end of July. Go ahead and get in there and get into the competition.
Absolutely. Check that out on ETF.com. In this week's podcast, we're talking with Greg Hall, PIMCO's head of global wealth management.
Hey, Greg, how you doing? Thanks for being here.
Hey, thank you, Jeff. Nice to hear you.
All right. Tell us a little bit about your role at PIMCO and some of your background, if you would.
Yeah, no problem. I'd love to. So I've been in finance. This is a little bit of a mark to market on me, but over 25, nearly 30 years now. And I've been lucky. I've worked at some wonderful places. I started at Goldman, spent about a dozen years at Blackstone, which was fantastic, and find myself now at PIMCO, which has just been a wonderful 7 years since I joined the firm. The last 4 years or so, I've been running our wealth management distribution group in the U.S. And that is all the sales of PIMCO products to the wealth landscape in the United States. I think your listeners will be very familiar. We cover the large wirehouses, we cover the independents, we cover the RIAs. We seek to work really closely with the home offices of those firms, but also get out and have really strong consultative, intimate relationships with advisors in the field. The overarching goal is to help them help their clients. We obviously look at a lot of things through the lens of fixed income, but we do try to take a broader view in those relationships and really try to find solutions that'll work for those advisors to do the right thing by their clients and help those clients achieve their financial goals.
I'm curious, you mentioned the looking through the lens of fixed income. Is that a specific part of what you're doing there is in the kind of working with wealth management? Because I would assume you would, if you're working with wealth management, financial advisors and institutional investors, there would be somebody looking through the lens of equity as well, right?
Yeah, I mean, listen, PIMCO began, 50 years ago, trying to bring the tools of active management to fixed income, where, prior, to that, it had been, a very sleepy area, and sort of the origins of the firm are really realizing that there's a lot of alpha to be had in active management within fixed income. And over the 5 decades of our existence, I think we've learned time and time again that we do best by really focusing on what we do best. And so the DNA of our firm is in fixed income, and I would say, related categories, macro investing, commodity investing, real estate investing, where there's real adjacencies to the fixed income world that is all about cash flows and rates and credit sensitivity. But we have tried to stay focused in our power alley, to use the consultant phrase, and to resist temptation to branch out into areas like equities, where other players may be better positioned to do that, or in some cases where the market has moved so hard to passive, there really is less of a case for active management in those spaces.
Okay, fair enough. As we get into this, I'm going to talk to you a little bit about some leveraged loan strategies that I'm working on, a story on that. But first, can we talk about some of the bigger trends that you're seeing in the ETF space today? I mean, this is ETF.com, so let's go down that road a little bit.
Yeah, but let me try your patience a little bit, because I want to zoom out a little on fixed income, and then we can get into the ETF side of things.
Okay.
From a top-down perspective, where we find ourselves in the fixed income market right now is a really, really exciting backdrop. And this is across product types, whether it's mutual funds, ETFs, SMAs. The initial conditions, the starting point of rates right now, means that, for the first time, and probably any of our investment, lives, you can create really safe, predictable income, for your clients, for your investors, in the 5, 6, 7% range, within traditional fixed income strategies. And that's a really exciting place for us to find ourselves. There has been, I think, a lot of focus in the marketplace, and certainly on a day like today, given the CPI news we've just received and the way the market's reacting to it, a lot of focus on when's the Fed going to cut, when's the Fed going to cut, when's the Fed going to cut. But the truth of the matter is that there's just tremendous value available in fixed income generally right now. And we think it's been an opportune time for people to invest in fixed income, to consider moving out of cash or moving out of other asset classes and rebalance toward fixed income. And so it's been a really, I think we've had some really good, high quality conversations with our clients, with advisors in the field, about when and how to do that. The second thing I would say, that I think is really important to the ETF conversation is the sort of the ongoing tension between active and passive strategies. We're fervent believers that active management is the right way to manage money in fixed income. There's a whole host of structural reasons why active management tends to work better in fixed income than it does in equities or in other asset classes. And I won't go through the whole litany of them, but I think you guys, probably, pretty aware the index composition within fixed income, is a much more difficult and clunky, construct relative to equity markets. A lot of the buyers and holders of fixed income, do so, like central banks, they do so for maybe non-economic reasons. They have other motivations in place. The indices themselves, when they're weighted to, those companies and issuers who have the most debt, not necessarily who have the most value. And so for all those reasons, there's just ample opportunity within fixed income markets to create value through active management. Our job at PIMCO is to outperform, right? That's our reason for existing, is to deliver really attractive investment performance to our clients. And as over the years, even though the core of that business has existed in mutual fund format for a very long time, we've begun to branch out into different product types. At the end of the day, we're here to deliver out performance. The clients will tell us the vehicle or the wrapper, the envelope they want to receive that performance in. And that's been, really catalyst for us to build up the ETF business. And today that business is, pushing $30 billion for us. That's an all-time high. Flows have been very strong of late. And it's growing more rapidly than the rest of our business as adoption in that space improves. And one of the more remarkable things about the ETF business in fixed income is that the growth of active strategies within fixed income ETFs has actually outpaced the growth of passive strategies, which is the polar opposite of what you've seen in the equity markets. And so we're really excited that ETF buyers in fixed income seem to agree with us that active's the right way to do it. And that's what's propelling growth in that marketplace.
Greg, as you mentioned, you're saying that active is where investors should be when it comes to fixed income. Do you have any numbers kind of illustrating, this idea that active performs better than passive when it comes to fixed income? And secondly, do you think that active performs better than passive in fixed income across all the different categories when it comes to corporates, treasuries, et cetera?
That's a great question. So I'm directionally, I've got this right. I don't have the exact number in front of me, but if you look at active fixed income strategies relative to passive fixed income strategies, and you kind of contrast that to the equity world, the majority of active fixed income strategies actually outperform their index or benchmark, which of course is not the case in equities. And I think that's why you've seen, when you look at the CAGR of active income or active fixed income ETFs, over the last 3 years, it's been about 21% versus total fixed income ETFs around 11%. So clients are telling us that they believe that active is the place to be, and that's reflected in the flows. I do think that there are sectoral differences in where you can create more value through active management on behalf of clients. And obviously, I think the more narrowly you define the construct of the ETF or the strategy, the fewer options you have to create alpha relative to the benchmark. So we, as a firm, and this is true of ETFs, it's true of our mutual fund business and other businesses as well. We do tend to favor relatively broadly defined strategies that give us the most opportunity to do interesting and creative things to generate value for our clients. It's not to say that a more narrowly defined strategy doesn't give you the opportunity to outperform. Something focused, purely on corporate bonds or clearly on leverage loans, which Jeff, you mentioned earlier, because of index composition, because of credit selection, because of the nuances of the fixed income market. Of course, there's opportunities to do a little bit better than the benchmark. But as you remove degrees of freedom, of course, you remove some ability to outperform.
If you're a financial advisor and you want to hear the latest insights and strategies in portfolio management, make sure to also subscribe to Advisor Upside, available wherever you get your podcast. Can we go back to leverage loans? I'm looking specifically at something in that area, and I'm wondering if PIMCO has anything on leverage loans in the leverage loan space, and what your thoughts are on that category in this market.
Yeah, thanks. Yeah, we do. We launched an ETF in the last year or two. LONZ is the ticker that's focused on that space. That's been a space that has been very popular with investors. It's been popular in traditional fixed income markets. I would argue, some of the popularity of private credit strategies and the retail BDCs and the growth of that category is adjacent to the popularity of leverage loans. Over the last few years, I think they've offered, a lot of characteristics that investors, have been focused on. Floating rate in a rising rate environment has presented at least the sense that you are immune from rising interest rates, whereas fixed rate, fixed income, less so, and there's more mark-to-market volatility. I think that as the leverage loan space has grown in terms of its credit appetite, it's been able to create a little bit of incremental yield, and so we're happy to have a relatively newer product in that space, something that started with a clean balance sheet in the latter part of that phenomenon, that's been able to select credits using its smaller size and nimbleness to really, I like to use the word artisanally, construct a portfolio that we think has a lot of durability and a lot of resilience. It's not corporate credit generally, and we've you can go to PIMCO.com and read a lot about this. We think it represents decent value. It hasn't been an area of favor or focus for us. We think that spreads are reasonably tight relative to history and relative to some other asset classes, and we've had a little bit of a bias to move more up in quality in terms of our credit appetite, given that it feels like we're approaching at least deep cycle areas, potential softness in the economy, and so in a lot of our broader strategies, we've tended to focus on, say, like the U.S. mortgage market, where credit quality is extremely high, but we certainly understand the appeal of the leverage finance space for a lot of investors, and it's important to us to have that as part of our product lineup.
What is the appeal? Is it the yield right now?
Yeah, look, I think I don't want to speak on behalf of all leverage loan investors in the world, but I think the nominal yield, the stated yield, is really attractive. I think the trailing performance looks really great on a 1 year, 3 year basis. I think we have to keep in mind that we have been in a very forgiving environment from a credit perspective. It's been very difficult, I think, to see real pressure on companies to meet their interest obligations. And we should also recognize that that pressure could increase, right? We're now dealing with much higher base rates. And as we kick around the phrase higher for longer, if that does end up being, the state of the world where we keep ticking along at much higher base rates and the interest coverage that these companies have to pay is that much higher than when the loans were originally underwritten, that's a problem. And it's a problem that people should be incorporating into their expectations for the long run yield of these assets. We just published a piece. It was yesterday, I believe, talking about exactly this topic, which is that with base rates higher than where they were 3, 4, 5, 6 years ago, when the leveraged finance and the private credit momentum was really building, a lot of companies that are borrowers in these sectors are having more and more trouble meeting interest coverage, capex requirements, and other sort of basic things they need to do as companies in order to be creditworthy. And so it is a risk that people should be cognizant of and be factoring into their forward views, even though the rear view, of course, looks pristine.
Okay. Again, I want to have you repeat that ticker symbol. Did you say LOMZ? Is that correct?
And N as in and I never know, the airline letter codes. I always come up with some ridiculous word, but N as in Nancy, LONZ.
Okay, gotcha. Thank you. And well, here we're recording this today on July 11th. The inflation data just came out this morning showing, I guess it's positive news because inflation had shown a pullback of 1/10 of 1 percentage point. And that's the first time we've seen that since 2020. There was an expectation of a 1/10 of 1 percentage point increase in inflation, according to the Consumer Price Index, or that's how it's measured. But do you anticipate a rate cut coming this year, maybe as soon as September? And what can you talk? Let's talk about what that could mean to the fixed income space.
Yeah, no, it's such an interesting time to be investing in fixed income markets. So I'd say a couple of things. Our base case, if you speak to our macroeconomists, our base case is for rate cuts this year. We think there's about a 70% probability of two of them, maybe as early as September. We say that with great humility. The Fed has signaled, very strongly that it is data driven and data dependent. And today we had a quote unquote good data point. We've had a series of them, but I think the story of the last 12 plus months has been, don't get ahead of yourself. You guys will recall, and I'm sure many listeners will recall, early summer last year, where we felt like we were in a similar situation, and by the end of the summer and into the fall, rates were headed back upward again on sticky inflation. And so there's just been, a lot of volatility. I think it's been, not to drone on again about active passive, but for us, again, it's another illustration of the value of active management. The ability to navigate this volatility and rate expectations has been key for us in terms of generating returns for our clients over the last few years. And I say that, in the sense of, trying not to get too excited when things look like they're headed in a downward direction and a rate cut direction, and trying not to get too concerned when they pop back up. And it was only a few weeks ago after the presidential debate where we saw a big move in rates in the opposite direction, based on what people were extrapolating coming out of that event. So I think our caution would be that things are likely to continue to be bumpy. And while our base case and our long-term assumption, continues to be that, the Fed will bring inflation under control and that rate policy will react accordingly. There's going to be a lot of opportunities to make or lose money along the way. And so we want to be really, really vigilant and not get, too complacent about where we think the state of the world is going to be.
Greg, we already talked about one of your ETFs. I want to touch on another one of your funds, which is the PIMCO Enhanced Short Maturity Active ETF, ticker symbol MINT, MINT. If I'm not mistaken, this was the biggest actively managed ETF for a while, but it's not anymore today. Why do you think the asset growth has slowed down for this fund? And why do you think investors should be taking a look at this ETF today?
Yeah, look, I think the product launched in 2009. We were early to the active ETF business and fixed income. It has been bigger, it has been smaller. It's been on a great run from a performance and from a flow perspective of late, which we're thrilled to see. We have a ton of confidence in Jerome Schneider and the portfolio management team behind that strategy. We have been, encouraging advisors to take a look at Mint and other short-term strategies as an alternative to, simply sitting in money markets or treasuries. We've been arguing that, stepping a little bit out onto the yield curve, taking on a little bit more duration, is probably a good idea as we edge closer and closer to the potential of a Fed rate cut. I think that's why it's experienced some growing, popularity over the last year or so. I think that advisors and their clients are really, really smart these days about where their cash is generating income and how much their cash can generate income. You've seen that, of course, as the migration to money markets has been, really just relentless over the last few years. And we think the next logical step is to push out a little bit into short-term strategies on a journey to, engaging more in call it, mid-duration fixed income strategies or more, diversified and higher degree of freedom strategies. So we're really pleased with where it is. We're really pleased with the performance, and excited. It's got such a long track record that people can evaluate for themselves.
What's it going to take to get people off the sidelines earning that decent yields in cash to some of these other things? I know I guess the textbook roadmap, blueprint, whatever you want to call it, says, start moving in that direction now, longer duration, what have you. But even if you're not a conservative or nervous investor, I mean, you're getting 5% in cash. What's wrong with that? I know that's not going to be anybody's, growth slice of their portfolio, but if you've got a fixed income slice with guaranteed 5%, I mean, how do guys like you make the case for getting people into something else in the fixed income side?
No, look, that is the question, right? I mean, that's really if I may, the $6 trillion question. And I think we have to start by just acknowledging that clients are smart, advisors are smart, and that's been a really logical place to be for much of the last few years. Now, you could argue the equity markets have powered upward, and it's possible some money's been left on the table. But if you just think in terms of pure asset allocation, it's really hard to fault an advisor or their underlying client, for doing exactly what you just described, which is being happy with a 5+% return, in essentially a risk-free asset. I think that the key point, for all of us to remember is those returns won't last. When you're investing in an overnight market and rates change overnight, well, then your rate goes down the very next day. And so you have reinvestment risk. And right now, the opportunity cost of that reinvestment risk is really high because you can lock in rates, in the high single digits, without taking on a ton of credit risk. And enjoy those rates over, a long term, even if the Fed cuts down to, more of a neutral rate, and those rates aren't available to you any longer in your cash accounts. And it's not going to be as obvious, I think, as people think when you've missed the opportunity to do that. So you have to start doing it now. You need to average in, and make sure that you're poised to take advantage of what, the market offers you today. The other point, I think to make, is just the opportunity cost of not having on, a little bit of duration as rates begin to move down, because that increases your total return potential. And so, some advisors and clients are very, very motivated by yield and pure yield, and we think that fixed income offers a solution to them. Others more motivated by total return. We think that fixed income offers a solution to them right now as well. It's hard for us to kind of poke holes in the thesis that it's not a good time to step out into fixed income and away from cash and potentially other asset classes.
Okay. Looking out across the lineup that you have there at PIMCO in the ETF space, what do you think is most interesting right now in the current environment?
Well, we love all of our children the same, and we think we've got a lot of terrific strategies. We've been, I think we tried to be judicious about how many strategies we launch into the world in the ETF space. We're not trying to be all things to all people. We've launched about half a dozen in the last year, and that, for all intents and purposes, maybe doubles or increases just under doubles our lineup of active ETFs, and that feels like a pretty good spot for us right now. Our focus is on making sure that the relatively recently launched products really work from a performance perspective, really work from a scale perspective. They develop the trading volume and the liquidity that clients want from them. I would say, we've had a lot of success of late with a vehicle called PYLD is the ticker, P yield for short. It's a broad-based income generating strategy. It's designed to look around the world at yield producing markets and create a dynamic portfolio that produces a really attractive rate of current income for its investors. It just crossed the $1 billion mark in recent weeks, and it's managed by a really great team here at PIMCO, led by Dan Iveson, our CIO, Sonali Peer, who does a lot of great work in diversified credit as a portfolio manager on that product. So we're really proud of that. We're excited about its prospects, and that does capture, I think, what I was saying earlier, about having degrees of freedom and the ability to look far and wide to find alpha on behalf of our clients. So it does distill some of those concepts. There's definitely other areas we're excited about as well. We've talked about Mint, BOND, is a more core bond type of exposure. A little bit, closer to, say, the traditional kind of ag-oriented product out there, but we're very excited about total return potential in that space as well. And then a couple narrower strategies where we think we've got, tremendous alpha potential, a little bit smaller, a little bit less core to investors' portfolios, but interesting nonetheless.
Well, fantastic. Greg, we're going to have to leave it there. This has been a really insightful conversation. Thanks so much for your time.
Oh, hey, thank you for having me. I really enjoyed it. Would love to do it again, and appreciate you guys spending so much time on this area of the world. It's an exciting place to be, and I'm sure your time is well spent, and your listeners are really edified by having the time with you.
Like that episode? Make sure to subscribe to Exchange Traded Fridays so you won't miss the next one. Available wherever you get your podcasts.